Okay, so as in previous lectures, I will start by repeating. I will start with repeating the important things from the previous lecture, and I will add some examples that I think are good to extend our knowledge a little bit on these topics. So in the last class, we were talking about the bonds, and we said bonds are actually financial instruments that allow governments, companies, municipalities, cities to borrow money. So how does it work? For example, if the US government wants to get some money, it needs it now, and they know that they will be able to repay it later because they will gather taxes, and they will have some money to repay back. But they need this money today. So they issue a piece of paper, and on this piece of paper they write, in a year from now I will give you $1,000. And this is like a zero coupon bond with a face value of $1,000. And in exchange for this piece of paper, you give them $950. And time passes by, 1 year goes by, and you still have this piece of paper. And it's written that in a year from now, you will get your money back, what's written there. So in a year from now, you give this piece of paper to the government, and government tells you, okay, here's your $1,000. And we said governments usually repay their debts because they know if they don't repay, it will be difficult for them to borrow again. And usually they are able to repay whatever they have borrowed because they can print money. It's as easy as that. The problems arise when governments issue bonds which are denominated in some other currency. Like Argentina issued bonds that were denominated in US dollars. When they didn't have money to pay back, they had to default on their debt. And what happens later is that in order for them to borrow money again, they have to offer much higher returns because they are risky. And this is the problem currently with Greece and Italy. They cannot print euros that easily. It's not that easy anymore to print euros. So if they could print euros, they could just print euros, give it to the debt holders, and that would be it. But they cannot do that. They don't print euros. Euros is a European, not a Greek currency. And we said if you pay 950, you basically end up with 5.3% yield. This is interest that you earn. This is the yield of this bond. This bond has yielded 5.3%. Or if you paid 980, and this depends on the market conditions, you would end up with 2% more. A typical bond looks like this. It's a piece of paper, and it has a written face value on it. Besides the face value, it tells you what is the size of the coupon. And it also tells you what is the frequency by which coupons are paid. And also, it tells you when the bond matures. So what does this mean? In a previous slide, we saw a simple example. $1,000 in 1 year. Well, when you have a bond like this, that means if the coupons are paid semi-annually. So this 10% coupon rate, pay attention, this has nothing to do with the rate that you will use to discount or to price bond. This 10% coupon rate just tells you what is the size of the coupon. It's the 10% of the face value but paid semi-annually. So half of the coupon is paid every 6 months. 10% of 1,000 is 100, half of that is 50. So this is the cash flow stream of the bond. If you own this bond, this is like you own this cash flow stream. In 6 months, you receive $50. In a year from now, you receive $50. In a year and a half, you receive $50. And finally, when this bond matures in 2 years, you receive the face value plus the last coupon. So this 10% that I'm mentioning here, this is not some interest rate that you use to discount bond. It has nothing to do with that. It's just used to calculate the size of the coupon. So this $50, how do I know that this is $50? Well, it comes from the fact that the coupon is 10% paid semi-annually. So 10% of the face value, but paid semi-annually. So half of it is paid every 6 months. And half of 10% of 1,000 is $50. Okay? So, but how do you price bonds? Well, this is just a cash flow stream. You calculate the present value of this cash flow stream, and this is how you calculate the price of the bond. Now, the question is, which R should you use to discount? Which R should you use to discount this bond. We will see later, and we saw in our last class, how do you actually, which R is used. But this has nothing to do with the coupon rate, with this 10% coupon rate. It has nothing to do with it. Now, we see that bond prices depend on this interest rate that we use to calculate the price of the bond. And we have seen in the previous class that if these interest rates in the market change, if they go up, prices of bonds will go down. We also saw that if interest rates go down, prices of bonds will go up. And we saw that actually if you compare two equal bonds, they are equal in everything except in their maturity. One lives for 2 years, the other lives for 4 years. The one with the longer maturity will be more sensitive to interest rates. This is what we have seen in the last class. But we said this holds only for the bonds that have everything else equal except the maturity. And we said, okay, let's construct a measure that will help us actually compare different bonds. Because we want to know how cash flow streams are sensitive to changes in interest rates, how the value of the cash flow stream is sensitive to interest rates. We said this is very important because banks are nothing else but the giant cash flow streams. And we want to be able to measure how sensitive our banks are to changes in interest rates. Why? Because, government can change these interest rates. If government changes interest rates, it might decrease the value of the bank so much that it could kill the bank. And they want to make sure that their banks are not so sensitive to changes in interest rates. Actually, they want to make sure that they won't make any changes in interest rates that would endanger banks. And why? Banks are not just normal companies. They are financial intermediaries. If bank fails, many other can fail. All people that have money in the bank might lose money. Unlike with Reve. If Reve fails, I don't lose money. I just go to a different store to buy stuff. But if bank that holds my money fails, I might end up losing some money. And if many people end up losing money, or many firms end up losing money, many people might end up also without their jobs, and governments will lose the elections, and they don't want to do that. So we said we need a measure that will help us estimate how some cash flow stream is sensitive to changes in interest rates. And we said this measure is called the duration. And how is the duration calculated? Well, here's an example. You have $1,000 US government bond with 10% coupons, which are paid annually. What does it mean? Every year you get 10% of the face value, and in the last year you get the face value plus the last coupon. So this is $100 in the first year, $100 in the second year, and face value of $1,000 plus $100 in the last year. Now we calculate the present value of each of these cash flows. Now let's say that we discount with a rate of 5% annually. We saw last time what are these discount rates that we use actually, but we will repeat it again in this class a little bit later. But let's say that this discount rate is 5%. If this discount rate is 5%, so what is the present value of $100 in a year from now at a rate of 5%? It's 100 divided by 1.05. So this is 95.24. What is the present value of 100 in 2 years from now at a rate of 5%? It's 100 divided by 1.05 to the power of 2. It turns out that this is 19.70. And now we repeat that for every cash flow. And then we calculate how much is that in percents of the total present value. So 1,136.16 is the total present value. This is the sum of these three present values. 95 plus 90 plus 950. This is this 1,136. Now, how much is 95.24 out of the total present value of 1,136? This is 8.38%. How much is 90.17% of this total present value? This is 7.98%, etc. And now we multiply these percents by the number of time periods. So 0.0838 times 1, this is 0.0838. And we repeat it like that. So 7.98 times 2, this is 0.16. 0.8363 times 3 is 2.51. Now this is some number in percents times some number in years. So this is in years. If you add these numbers, you end up with 2.75 years. This is the duration of this bond. This is 2.75 years is the duration of a bond, of this bond. Now the question is, what does this number means? What is the meaning of these 2.75 years? One interpretation of this number could be is that this bond is as sensitive to changes in interest rates as the zero coupon bond that matures in 2.75 years from now. So this tells us how much approximately price of a bond is sensitive to changes in interest rates compared to the other zero coupon bond. Now, but this number tells us more. And we saw the example in the previous class. If we observe exactly the same bond, what the duration also tells us. Let's say that the current yield is 5% like in this example. In this example, current interest rate that we use to discount bond is 5%. If the current interest rate is 5%, if it goes up for half a percentage point to 5.5, and if it goes down for half a percentage point, 4.5, we want to be able to say how many percents will price change in this span of percentages. And it turns out that it will change for the duration over 1 plus yield percents. So I gave you an example. We have this bond that we have calculated that has the duration of 2.75 years. Now, what is the price of this bond at 5%? It's $1,136. Well, if the interest rate goes up to 5.5%, price will go down to $1,121. If interest rate goes down to 4.5%, price goes up to $1,151. Now, how many percents did this change? So in the first case, when the interest rate went up from 5 to 5.5%, we observe the decrease in price of 1.3%. So 1,121 is 1.3% smaller than 1,136. Now, if you observe again the change, but this time from 5 to 4.5%, so decrease for half a percentage point, we will see that this is actually leads to increase in price of 1.32%. So price went up from 1,136 to 1,151, which is 1.32%. So basically we see that for this change of 1% around current yield, around this current 5%, for the change of 0.5% up, 0.5% down, we see that price in total has changed for approximately 2.62%. And actually, this is what we get if we use the formula duration over 1 plus yield, 2.62%. Okay? So the duration tells you more. It doesn't tell you only that this bond is as sensitive as the zero coupon bond of the equal duration. And actually, zero coupon bonds have the duration equal to their maturity. So the duration of a zero coupon bond that matures in 10 years is 10 years. So this number over here tells you if we change the interest rates for 1% around current interest rate, price of a bond will change for duration over 1 plus yield percent. Okay? So this is 2.753 is the duration. divided by 1 plus current interest rate, current yield, which is 5%, 0.5. So we just divide that and we get 2.62.
And you don't have to do it for the other ones, when interest rates decrease or increase?
So we don't have to do, we don't have to do that if you know the duration. This will be approximately true always, but this is approximately true. So this number will be approximately equal to this plus this. But if these changes in interest rates are large, if you try to change interest rates not by 0.5%, but by 5%, that it jumps from 5 to 10%, you will not be able to get such a nice estimate, because this works only for small changes in interest rates. But this is usually enough, because governments usually change interest rates just by a little. You will never see government changing interest rates by 10 percentage points. I mean, this doesn't happen. They change it for 0.5% or even less. Okay? Questions, comments, short speeches? Okay, we move further. I mean, this is what we have done in the last class, to remind you. This is what we have done. There is nothing new yet. Now, if you observe, we said, if you go to a bank and invest money for, 1 month, you will get one rate. If you invest money for 10 years, you will get a different annual rate. And actually, you can observe exactly the same thing on the yield or return of the US government bonds. 1 month US government bond will give you, let's say, 1% annual yield, while the 30 years US government bond will give you a different annual yield. And we said these different yields for these different annual yields for different maturities give you what is called the yield curve. So it's called the yield curve when it's the US government bonds, but it can be yield curve of IBM bonds. Of different bonds have different yield curves. So what do we use this yield curve for? Well, we use it to calculate present value of almost any cash flow stream. So imagine that you have a cash flow stream that is a US government bond. And let's say that you have the following US government bond. $1,000, 10% coupons, which are paid annually and matures in 4 years from now. That means 10% of the face value every year, and at the end you get the face value plus the last coupon. Now, how do we use this bond to calculate the price or the present value of this bond? Well, how do we calculate the present value of any cash flow stream? We have to discount each cash flow in this cash flow stream with the corresponding discount factor. Now, I can tell you that, for example, this yield curve is expressed in continuously compounded rates. But I must be specific, because this doesn't have to be continuously compounded rate. But if it is continuously compounded rate, then we would first we need to calculate the present value of the first cash flow, which is $100 in a year from now. What is that? This is 100 divided by e to the power of RT, or multiplied by e to the power of minus RT. But which are? This is investment, this is cash flow that takes place in year from now. So we need a 1 year rate. How do we get this 1 year rate, this R1? Well, look at the chart. Look at the animation at the chart. You find the value of the yield curve. What is the value of this red function? Yield curve is a function, is a curve. What is the value of this curve for the x equal to 1 year? Well, this is the value of this function. Let's say that this is R1. Let's say that this R1 is 2.5%. Now, what is the present value of $100 in 2 years from now? It will be e to the minus 100 times e to the minus R2 times t. T is now 2. And what is R2? Well, let's check on the yield curve what is R2. What is R2? What is the value of the yield curve for x equal to 2 years? Well, let's check. And let's say that this is R2. So this is, let's say, 2.8%. Now let's repeat the same exercise for R3, R4. We find what are R3, R4, and we discount each cash flow stream with the corresponding discount factor. And we get to some price. And we can calculate this price. This is a number. This is $1,251. Now, alternatively, I could have told you this yield curve is, you have to read when somebody gives you a yield curve. In which units is this yield expressed? Is this continuously compounded rate? Is this annually, daily? How is this compounded? If this yield curve was expressed in annually compounded rates, this is how you would calculate the price of this bond. You would have to use discount factor with the annual compounding. There is nothing complicated about this. But now, you can ask me, okay, but where do I get this yield curve from? I can tell you, I go to the website of the US Treasury Department, and they publish this yield curve every day. Every day they give you a new yield curve. So to calculate the price of the US government bonds, I need the yield curve for the US government bonds. If I was to calculate the price of IBM bonds, I would need the yield curve for the IBM bonds. These are different. You get different rates if you invest in IBM or in the US government. I'm losing voice totally. This will sound ridiculous recorded, but what can I do? Okay. Okay, but how do you get this? What in reality, if you go to the website of the US Treasury, what is actually written there? In which units is expressed the government yield curve that they are publishing on the website of the US Treasury? Well, I went to their website, and actually this slide, the next slide, consists, I have copied everything. Everything is copied from the help of the website of the US Treasury. And they tell you the following. They'll tell you these rates that you see in the yield curve, they call them constant maturity treasury rates, are not annualized percentage yields, translated to the language that we are used to. These rates, these yields that you see on a yield curve, are not effective annual interest rates. This is not what you get after 1 year. What you get after 1 year is actually this, they tell you. So what does this mean? This actually means that the rate that they give you at their websites are expressed in nominal annual rates, but with semi-annual compounding. They compound every 6 months. So what does it mean in reality? They give you the following example. This example is taken from their website. They tell you, if we tell you that the 5-year maturity is giving you 8% per year, that doesn't mean that per year you get 8%. No. That means that every 6 months you get 4%. So they quote everything in semi-annual compounding. So this is nominally annual. So nominally you get 8%, but in reality you get 4% after 6 months plus 4% after 6 months. So basically after 1 year you get 1.04 to the square. This is the idea. So how do you calculate what is the real effective annual interest rate? The effective annual interest rate is 1 plus nominal divided by 2, and then everything to the power of 2, then minus 1 and times 100. But the idea is they quote everything. You have to check it. And for different bonds, different yield curves, it might be differently. You have to check it because 8% is not the same thing as 8.16%. It's quite different.
But how do you know that they compound semi-annually? Because they just write it's not annualized percentage.
So, but they tell you this formula is from their website. This example is from their website. So this is not invented by me. I have copied, this slide is a copy from the help of the website of the US Treasury help. So they express their rates with semi-annual compounding. So 8% doesn't mean 8% per year. It means 8.16% per year. So how do we price our bond now? How do we price the same bond? But let's now say that actually these numbers come from the website of the US Treasury. So they are not continuously compounded like in the first example that I have solved. They are semi-annually compounded. How do we calculate the price of this bond? Like this. What does this mean and how do I get to this equation? Well, if R1 was the effective interest rate, I would discount the cash flow stream in year 1 with 1 plus R1. But it's not like that. This is nominal interest rate. So effectively, how it works, I have $100, which I have to discount 2 times for 6 months with the 6-month rate. And the 6-month rate is R1 divided by 2. This is what we have learned. But how many 6 months periods are in 1 year? The fact that this is in 1 year, and you see I'm discounted with something to the square, this is because this rate is actually 6-month rate, R1 divided by 2. This is the effective 6-month rate. And you know, the cash flow that appears in year 2, I discount with 1 plus R2 divided by 2, everything to the power of 4. Even though this is the second year, this is the second cash flow, and I discount it with something to the power of 4, because there are 4 6-month periods.
But they say that it's annual in this case, or?
Sorry?
They say that it's annual.
Where do you see that?
It's there.
No. Look. Coupons are paid annually. Coupons for this bond are paid annually. So this tells us how to construct a cash flow stream. This is how we construct a cash flow stream, and that is okay. But which rate do we use to discount this cash flow is the question. So, in a sense, I don't discount with 1 plus R1, the first cash flow stream. I discount it with 1 plus R1 divided by 2 to the power of 2. This is because this curve, this R1 that I read from this curve, is not effective annual interest rate, but this is nominal interest rate. If I read from here 2.5, R1 is equal to 2.5. That doesn't mean that if I invest in a 0 coupon bond with 1 year maturity that I will earn 2.5%. No, that means that after 6 months I will earn 1.25%. And where do I get this from? From the website of the US Treasury. I mean, this is what I have explained you. This is not written in this slide. This comes from the fact that this number is taken from the US Treasury curves from their website. So after 1 year, I will actually get 1.025 to the square. The 1.025 divided by 2. So it will be 1.0125 and everything to the square. Is this clear? I have pressed the mute button, so this won't be in the recording. Okay. So if you plug in numbers now into this equation, this is what you would get. You would get 1,123. Unlike with the continuous, it was something different. Okay. Also, we said that the important concept is yield to maturity of a bond. We are still in the last class. I mean, we are still revising important stuff. So we said that the important concept is the yield to maturity of a bond. So what is the yield to maturity? Imagine there is some bond which pays you 6% Coupons paid semi-annually. What does it mean? And it has face value of $100. What does it mean? Last payment is $100 plus the last coupon, and the size of the coupon, if this is 6% paid semi-annually, that actually means 3% every 6 months. So this is $3, $3, $3, and finally last coupon plus the face value. Now, let's say that you call your broker, and he tells you, price of this bond is $98.39. So this is the price in the market. This is like you go to a supermarket, there is pasta on a shelf, and it tells you the price. This is the price. You don't calculate this price. It turns out that this price that you observe in the market is quite similar to the price that you would obtain if you calculate it by discounted on the yield curve, by using the yield curve. It will be very close. Often it will be equal. But this is the price. If you give somebody 98.39, he will give you this bond in exchange. And now what's the yield? Yield is basically a return that you get if you buy this bond now and hold it to maturity. This is yield to maturity of a bond. So if you pay today 98.39, this is current price, and keep this bond until maturity, and you receive these cash flows, 333, 103, your yield to maturity, you will earn 6.76%. Okay, now let's complicate things just a little bit more and do it in discrete time. And now I will intentionally try to confuse you so you would understand things better. So imagine the following bond. $1,000 face value, 10% coupons, paid semi-annually. So what does it mean? Coupons are $50 because this is 5% every 6 months. This is what this 10% semi-annually means. This 10% has nothing to do with yield to maturity or with yield curve. This 10% just tells you what is the size of the coupon. Don't get confused. So this is how the cash flow stream of this bond looks like. Now, I will use completely different notation that I have used so far in order to confuse you, in order so you would better understand. I will tell that the price of this bond, forget about this with yield to maturity, just look at this one, 50 divided by 1 plus R1, 50 divided by 1 plus R2, etc. What I'm trying to tell you here. Now observe, I'm discounting something that comes in 6 months with 1 plus R1. What is this R1 in this case? This is not a number that you will read at the yield curve.
Yeah, that have to be in a semi-annual discount, right?
Yes, this has to be half of what you would read in the yield curve. So if you read that the 6-month annual interest rate is 10%, in this case, this would be half of that, if the yield curve is expressed with semi-annual compounding. Okay? Because you see, this is something that arrives in a year. I'm discounting with 1 plus R2 to the power of 2. Now, R2 is not the number that you will read at the yield curve. Yield curves are in annual terms. And you know, you need a semi-annual thing here, because annual thing you are discounting with to the power of 2. You understand? I'm doing this to try to confuse you on purpose, because you know, in real life, when somebody gives you some cash flow stream, some rates, you have to think in which units is this. Is this per year or per 6 months? If it's per year, is it nominal per year, or it's per year, is it effective per year or nominal with some rate of compounding? So which the compounding rate is. So in this example, this is 6-month rate. So R1 is what you will get if you invest your money for 6 months, not for a year. So this is not annualized. This is not annualized rate. This is not what you get per year. So in this example, you could calculate the price of this bond. And let's say that these rates are, now these rates of 2%, 2.5, 3, 3.5, I have just invented them. I haven't read them from anywhere. They are not related to any previous example in the slides. They're just invented. So what does it mean? In this example, it would mean that for things that mature in 6 months on a yield curve, it would be actually written 4% in the US Treasury because they quote things with semi-annual compounding. So it would be double that. So one annualized 6-month rate would be 4%. Annual rate for 1 year bond on the yield curve would be 5%. You understand this? This is intentionally. Try to understand these slides and connect them to the previous slides. R1 in this slide means something different than in the previous slide. In the previous slides, we were reading R1 from the yield curve. Now we are reading R1 times 2 from the yield curve. Okay? And now what would be the yield to maturity in this example? Well, yield to maturity would be the discount rate that would set present value of this bond equal to its price. And this is the price of the bond. We have just calculated it. And you know, this bond will most likely be traded at $1,057 because this is its present value. Now, but when I tell you that the yield to maturity of this bond is 3.45%, this is not per year, this is per 6 months. You understand this? So this is the rate that you would get per 6 months if you invest into this bond. But yield to maturity is usually expressed in annual terms. So one could say, what is the nominal annual rate of this bond? It's 6.9. You said it well. So this is the nominal annual rate with semi-annual compounding. Compounding would be double that. But what would be effective? What would you actually get after 1 year?
The yield to maturity divided by the power and the power times 2?
It would be 1 plus this to the power of 2. And then minus 1 times 100. You understand?
Yeah, but in every step?
No. But you see, in every step, yield to maturity is exactly the same. It's the same rate. That's the point of the yield to maturity. Yield to maturity tells you, okay, if I buy this bond for the price that is currently being sold for, so if I buy this bond for $1,057, how much in percents I will earn until it matures? Well, you will earn 3.45% per 6 months. So how much is that per year? Well, it depends in which units. If compounded semi-annually, nominal interest rate would be 3.45%. This would be your yield. It would be 6.9. But effectively, what we would actually get in terms of money, it would be 1.0345 to the square. Because after 1 year, you know, you invest $100. After 1 year, you get 103.45. After 2 years, you get 103.45 times 1.0345. So you get that, then minus 1 to get it in, you know, because this will be some number, 1 point, I don't know, 10 or 1.9, I don't know, 1.11. Then minus 1, this will be 0.11. And then times 100, this will be 11%. Okay? Do you get, I mean, just ask if something is not clear.
I just wondered because you mentioned that I buy this bond in the last period.
No, you buy this bond now.
Okay.
You buy this bond now for $1,057 and you keep it until it expires. You never sell it. You just receive the cash flow of 50, 50, 50 and 1,050. And the interest rate that you will get by this investment. So, I mean, observe this as an investment. Observe this as an investment in which today you invest $1,057 and then in exchange you get $50 in 6 months, $50 in 12 months, $50 in 18 months, and $1,050 in 2 years. Observe this as an investment. And I ask you, how much in percents do you earn on these investments? Well, you use yield to maturity percents, but this is 3.45% per 6 months. in this example. And how much do you earn per year? Well, it depends in which units. If it's effectively what you earn per year, it will be 1.0345 to the square, and then minus 1 times 100.
So how did I get the R in the first place? I'm still stuck on that.
How did you get this R1, R2, R3?
Yeah.
So this is something that you would get from the yield curve for the bond. So if this is the US government bond, you go to the website of the US Treasuries, and you would read these numbers. But note that in this example, you wouldn't read directly R1. You would read actually R1 times 2.
Yeah.
This is something that you would observe on the yield curve. You would see annual nominal interest rate for the 6-month investment. Okay? Okay, but now let's think how actually, you know, US government gives you this yield curve. But where does this yield curve comes from? This might clear up some things. Now we are moving to something quite new. And this might clear up some things. So observe this table. I tell you, this table, there is nothing calculated in this table. Everything is given. So what is in this table? We have 5 different bonds. First column tells us what is the face value of these bonds. Second column tells us what is the maturity of these bonds in years. That means that the first bond matures in 3 months, second in 6 months, third one in 1 year, 1.5 years, fourth one, and the last one, it matures in 2 years. This is the maturity of the bond. This is how long they will pay you something. Now, what is this thing over here? The third column. The third column tells you what is the coupon size. This is like in percents. So this is, first 3 bonds are 0 coupon bonds. There are no coupons. The last 2 bonds pay you 8% and 12% coupons, but they are paid semi-annually. So what does it mean? It means that the last bond will actually pay you $4 every 6 months, and in the last period it will pay you $104. Is this clear what is in this table?
But how do you know that it is semi-annual in this case?
Usually, I mean, I'm telling you, this is an example, and let's say it's written on a bond, because if you take a bond, these are the numbers that are written on bonds. I mean, this is a contract. Bond is a contract, nothing else. These things are given. These things are not calculated. It must be clearly stated how frequently coupons are paid. You don't calculate this. You don't have to be smart to figure it out. It must be written on a bond. And the last thing, last column, is the current price of this bond in the market. So this is not calculated. This is what is written. This is the price that somebody is willing to sell you this bond. If you want to buy bond number 1, you have to pay today $97.5. Okay, so there is nothing calculated here. We have 5 bonds in the market. We know properties of these bonds, coupon rates, maturity, and the face value. And we know their prices. And now what we want to do is to say, okay, what is the yield to maturity for investment in government bonds that matures in 1 year, in 3 years, in 5 years, in half a year, in 1 month? We want to be able to answer these kind of questions. So how is this done? Now from this table, it's kind of obvious how you can calculate what is the yield that you get if you invest in government bonds for 3 months. Because you have a 3-month bond here. The first one is a 3-month bond. So if you buy this bond today for 97.5, in 3 months you will be able to sell it for 100. Therefore, you know that your return on this bond will be 2.5 divided by 97.5. But this will be the 3-month return. Because in 3 months, out of 97.5, you have made a profit of 2.5, okay? So if we want to express it in nominal annual terms with quarterly compounding, we would multiply this number just by 4. Okay, so it would be 2.5 divided by 97.5, and we multiply that by 4, and we get 2.556% annually with quarterly compounding. If you want to know what's effective rate, you would take 1 plus 2.5 divided by 975 to the power of 4, minus 1 times 100. Okay? Is this clear?
So this one is nominal and compounded.
So this is nominal with quarterly compounding. But we can do it also with continuous compounding. We can say, okay, how much this earns when you calculate continuously compounding. What does it mean? If you invest $97.5 and then you compound times e to the power of RT, where t is 0.25. This is 1 quarter. You get 100. You understand this equation? This is just a continuous compounding. If you invest today $97.5, let's forget about this part of the equation. If you invest today $97.5 at the rate of 20%, after 1 quarter, how much you will get? You will get 97.5 times e to the power of RT. T is 0.25. This is 1 quarter of a year we are talking about. So how much do you get? Well, you get something. But if I tell you, okay, you get 100 after 1 quarter, how much you have earned in percents? Well, you have to find R from this equation. Is this clear? And this equation is quite easy to solve. You just divide by 97.5 both sides, you take the logarithm, and you solve it. And you get 10.127%. So in continuous compounding, you would end up with a rate of 10.127%. Yes?
Just a question. In slide 9, it said on bond pricing, it was like 100 e to the minus RT. And now it's...
But this is not bond pricing.
this,
I'm not discounting anything here.
so it's not the same...
That's not the same thing. I mean, just think about what I'm doing with this equation. Think about what I'm doing with this equation. I'm asking myself, imagine that I have $97.5 today, and I invest it at some rate for 1 quarter. How much do I get? And if after this 1 quarter I get $100, which rate do I get? This is the question that I'm trying. If the future value of $97.5 after 1 quarter is 100, what is the rate that I've used? And we have obtained that for an investment of 1 quarter, of 3 months, if I invest in a government bond for 3 months, it's a 0 coupon bond. It has only 1 payment in 3 months from now. If I invest $97.5 now, in 1 year, in 1 quarter, in 3 months, it will give me $100. How much I have earned? I have earned 10.127 annually with continuous compounding. Okay, so this is the annual rate. This is per year. I earn 10.127 per year with continuous compounding. Now I can repeat the same exercise and I can get answers. How much do I get if I invest my money in a 6-month bond or in a 1-year bond? Because there are 0 coupons. I can apply exactly the same methodology. I can exactly the same equation, just here I will use the bond price of the thing that matures in 6 months, and T will not be 0.25, it will be 0.5 for a half a year bond. Or for a bond that matures in 1 year, T will be 1, and there will be the price of a bond. And if I calculate these interest rates, I will get 10.469 and 10.536 for half a year bond and for a 1 year bond from this table. This is just repeating the same thing. Now the question is, how much do I get if I invest my money for 1.5 years? And now the problem is getting complicated. Because if you look at the 1.5 year bond, it pays coupons. It will give you one coupon after 6 months, the other coupon after 1 year, and after 1.5 years, it will give you face value and a coupon. So it's not so clear how to calculate from the price of this bond, how to calculate rate that you would get if you invest money now for 1.5 years, because this bond will give you some cash flows in half a year and a year from now. But we have calculated already what are rates for 6 months and 1 year. We have just did so. So we can write the price of this bond. Price of this bond must be equal to the discounted cash flow of this bond. Price of this bond must be equal to the discounted cash flow of this bond. I mean, maybe it would be easier for you if in the previous slide, in this slide, if instead of writing here 97.5 times e to the power of 0.25 times r is equal to 100, if I have written that price today, 97.5, is equal to 100 times e to the power of minus rt. But it's the same thing, it's just moving thing over here, it's the same thing. You see, this was your question in a sense. So if you say price today, and price today is 97.5, it would be equal to 100 times e to the power of minus 0.25 times r. It's the same thing. Okay. So how do you calculate then 1.5 year rate? Well, we have calculated 6 month rate, we have calculated 1 year rate, and cash flow stream of a bond that matures in 1.5 year rate, it has coupon of $4 in 6 months from now, $4 in a year from now, and $104 in 1.5 years from now. So what's the price of this bond? It must be equal to the discounted cash flow of this bond. And we know what is the 6 month annual rate. We have calculated. It's 10.469%. We know what's a 1 year rate. It's 10.536%. So the only thing that we don't know in this equation is this r, 1.5 year rate. So now we are able to calculate 1.5 year rate. Once we have 1.5 year rate, then we write the cash flow stream of a 2 year bond. And for 2 year bond, it will have coupons in 6 months, 1 year, 1.5 year. We know these rates. So the only thing that will be missing is the 2 year rate. And we can calculate 2 year rate, and it's 10.808. And once we do that, we plot these points on a chart. This is the first rate, the second rate, the third rate, the fourth rate, the fifth rate, the sixth rate, the seventh, whatever. We plot these dots on a chart. And now, what the US Treasury will do, you see, there is some relationship here. They will try to approximate this relationship between the maturity and the yield to maturity with some function. This function is this red line. This is a mathematical function. F of x is equal to something. So, this is some function. Now, they use some special method called quadratic splines. And actually, you can see that on the website of the US Treasury. They use quadratic splines to estimate the formula of this function. And this function tells you, for any value of the maturity, so let's say for, 368 days. So this is 1 year and a little bit more. You can calculate what is the yield, because this function, if you plug in x, if you plug in number of days, years, whatever, 367 days, it will give you some value on the yield to maturity. Now you don't need to know how to estimate quadratic splines. I mean, this is outside of the scope of this class, but you should understand that, people do that. And actually every statistical package can do that. I mean, this is not so complex. Every statistical package can estimate the yield curve using quadratic splines. Now, in normal times, yield curves are usually upward sloping. What does it mean? It means that if you invest money for 1 year, you will get less per year than if you invest your money for 30 years. If you invest money for 30 years, you will get more in terms of percents per year. Not only more in total, of course you get more in total, but you will also get more in percents per year. This is what yield curve tells us. But there are some special times. There are some very special times when this yield curve gets inverted and becomes like this blue line. So normal yield curve is upward sloping. It's increasing with maturity. This is the red line. This is the normal yield curve. In some special times, yield curve gets inverted. And one guy called Campbell Harvey, until recently he was the editor of the Journal of Finance, in his PhD thesis, he showed that inverted yield curves, when you observe them in the market, because this is what we calculate from the market prices. This is not something that somebody gives us. We can calculate it from the market prices. When we observe the inverted yield curve in the market, this is a good predictor of the recession. That means that the economy is soon going to do really badly if you observe the inverted yield curve. Now,
So that means that there's deflation in the economy, for example?
I mean, it doesn't have to be the deflation. It doesn't have to be the deflation. It means that growth is slowing down most likely, and maybe even becoming negative. Maybe economy shrinks. Now, why is that the case? The idea is the following. Imagine that you are expecting that something really bad is going to happen in the market, that market is going to crash. So what's your strategy? What do you do? Well, let's buy bonds now. Because if I buy bonds now, government will be paying me some good amounts of money in the future. So on my investment now, if I buy investment for 30 years now, I will get nice interest rates. But, everybody is thinking so. I'm not the smartest guy in the class. If I believe that the markets are going to crash, everybody believes that market is going to crash. So everybody will try to move their money from the stocks to the bonds. As everybody is trying to do so, interest rates are going down because prices are going up. I say, I pay $98 for this bond, and you say, no, I give 99. So prices are going up, and therefore interest rates are going down. Now, if you ask me, but what's the current situation with the bond markets? Well, in some countries, they are weird. If you observe Italian yield curve, it's not inverted. It's what's called hump-shaped. It's kind of increasing and then decreasing. It's weird. So what do we know from this? I don't know. What do we know? Nobody knows. If I knew, I would be rich, probably. But the point is something weird is going on. And the other problem is also currently, because people are afraid that, Italian government won't be able to repay their debt, or Greek government won't be able to repay their debt. These yield curves have shifted upwards a lot. What does it mean? That in order to be able to raise money by issuing debt, Italian and Greek government has to pay lots in interest rates. Nobody is willing to give them money for 3%. Nobody is willing to give them money for 1%. In order for Italian government to raise money, they have to pay 7% interest. I mean, this is worse than some war messed up countries.
7% for what maturity?
Yeah, but it's different. But in general, it's shifted a lot above. For all maturities, it's shifted above. So 1 year bonds pay like 7% per year. I mean, this is like, if you go to some war-destroyed countries like Serbia, they offer like 5%. And Greece is offering like 20%. I mean, this doesn't make any sense. But it makes sense because people are afraid that Greece is going to default or their debt. They will not repay everything because they cannot print euros. This is the problem. Okay. So, what we observe on the yield curve, yes?
Just one more question to the inverted yield curve.
Okay.
Because I think I understood that interest rates are going down when all the
Well, we are expecting some secular movements in a sense. We are expecting that the growth of economy will shift in the long run. So we currently, I don't know, have the growth of economy of, let's say that you, in normal states, you have a economy is growing at, I don't know, 4 or 5%. But in the because of the recession, you expect that in the long run, economy will grow at 3%. And you know, the big problem with borrowing money at the rates which are, so the big problem is the following. Imagine you are a country. You want to borrow money, and you borrow money at the rate of 7%. But your economic growth of a country is 3%. This is problematic. I mean, you can never repay this debt in a sense. I mean, this is like a big giant Ponzi scheme. In order to repay this debt, you will have to take more debt on yourself. Or you are counting that your population will grow and in such a way produce more. But the point is, I mean, populations don't grow anymore in developed world. They are actually going down. And if you borrow money at a rate which is higher than your growth rate, this is very, very tricky. You might end up never being able to repay your debt. So, from the yield curve, we observe what are called spot trades. Yield curve tells us if I invest in the US government bonds, if this is the yield curve, it tells me if I invest for 5 years, how much per year I will get. Well, you can read it from this chart. You can read how much you would get per year if you would invest for 6 months, etc. Now, there is another rate which is called forward rate. Now, what is the forward rate? What is the forward rate? Forward rate tells you if you go to a bank and ask them, okay, can you tell me, I want to borrow money, but not now. I want to borrow money in 2 years from now for 1 year. Can you commit to some rate today? So this is the forward rate. Forward rate is not what you will get, so you wait for 2 years, and what you get after 2 years for 1 year. No, this is the future spot rate. Forward rate is something that you would get if you sign a contract today for the future investment or for the future loan. To give you an example, why is this useful? Imagine like before, like in our first or the second class, you are a baker. And you are approached by the Reve supermarket, and they tell you, we want to sign a contract with you, we like your bread, and you will have to deliver 100,000 pieces of bread per day. And you tell them, you know, I cannot start producing this bread immediately. I mean, I have to build some things to increase my bakery and stuff like that. No problem, I will do it, but let's start our contract in 2 years from now. They will tell you, okay, no problem. We will start let's sign a contract today. Let's sign a contract today that in 2 years from now, you will start selling me bread. And let's fix the price today. So let's fix the price today. And you tell them, okay, I can sign this contract, but you know, I have to go to a bank to ask money to ask for a loan in 2 years from now for flour, for gas, for the burning, for yeast, for water, whatever, salt that you need to produce bread. Because, you know, in 2 years from now, I will need lots of flour. I mean, 100,000 pieces of bread, that's a lot of flour, and I need a loan to cover that. I don't have this kind of cash. I will make money on this, but I don't have this. And, you know, if you go to a bank, you know what is your current interest rate that they will charge you, but you don't know what will they charge you in 2 years from now. But actually, it turns out that you can't sign this kind of contract in a bank. If you go to a bank, they will tell you, okay, no problem. In 2 years from now, we will give you 1 million euros for 1 year. But at which rate? How much they will charge you? This is the question. They will charge you what is called the forward rate. This is some rate that takes place in the future, but you have contracted it today. You have a contract today. And you need this rate in order to be able to tell to Reve what is price of your bread going to be. But this is not the future spot rate. So this is not the rate that you would got if you were waiting for 2 years and then asked for a loan. It's a different rate. Because you have no idea what is going to be a 1-year rate in 2 years from now. I mean, these things change in the market. But you can fix the rate today. Now the question is, which rate is bank going to charge? How many percent is that? It turns out that we can calculate this. Now, so what is the example of the Reve supermarket? This is the example. Imagine you know that you will need $100 for an investment that will take place in 2 years from now, and you will repay it after 1 year. So you can do two things. You can wait for 2 years and then take a loan. Or you can alternatively go to a bank to sign a contract to them and ask them which rate they will give you. The first thing is what is called, you will get some future spot rate, and you have no idea what this rate is going to be. There is uncertainty. You have to wait for 2 years and see what market tells you. I mean, I don't know. But this rate is fixed today. This forward rate is fixed today. This is something that you fix today, 2 years in advance. Now it turns out that we can actually calculate what this rate has to be. It turns out that we can calculate it quite easily. Now, just for a moment, completely forget this previous example because it will confuse you. I have seen that in previous classes. This is the 5th session that I'm teaching. So now press the reset button, forget about the previous example of Reve. And now imagine that you want to invest your money in a bank for 3 years. You go to a bank and ask them, okay, I want to give you my money now, today, and I sign one contract. And this contract tells me, okay, after 3 years, you will get this and this amount of money. Which rate you will get? This is quite simple. You will get, if you invest $100, you will get 100 times 1 plus some interest rate, R3, let's call it, this is the rate for the 3-year investment in a bank, let's call it R3, to the power of 3. This is just a simple compounding, if it's annually compounded, okay? So, this is the left-hand side of this equation. This is what you get with this contract. The left-hand side of this equation, okay. You invest $100, after 3 years, bank will guarantees that they will pay you $100 plus the interest. Now the question is, can you have exactly the same cash flow, but let's make a different contract. Let's make the following contract. You go to a bank and you ask them, okay, I want to invest my money for 3 years, exactly as in the previous example, but I want to have 2 contracts. First contract, I invest $100 for 2 years. They tell you, okay, no problem. In this contract, after 2 years, you will receive 100 times 1 plus R2 to the power of 2. But also today, you are signing additional contract, which tells you, by this contract, I will invest 100 times 1 plus R2 to the power of 2 for 1 year more, but in 2 years from now. And bank tells you, okay, no problem. We give you the forward rate from year 2 to year 3. This is the Baker's contract. So out of these 2 contracts, Baker has only one contract, only this forward contract. He invests money in 2 years from now, or he borrows money in 2 years from now. So left-hand side and right-hand side of the equation, left-hand side describes what happens if you enter a bank, invest $100 for 3 years. Right-hand side tells you what happens if you invest $100 now for 2 years, you get this. Then after 2 years, you invest this money at this rate. But you know, everything in this right-hand side, this is a contract today. So effectively, you invest your money today and you get it back with some interest after 3 years, not after 2 years, because you have already signed a contract from year 2 to year 3. This is not that you can wait for 2 years and then say, yeah, no, I don't like this contract. No, you have signed this contract. So right-hand side is investment today for 3 years. Left-hand side is investment today for 3 years. This is the same. So they must offer you the same returns. And actually, you can generalize this formula by replacing 2 and 3 with B and A and B. And if you plug in numbers, let's say that the annual interest rate for investment of 2 years is 4%, annual interest rate for 3-year investment is 5%, then you can actually calculate what bank will charge you for investment made today, but from the year commitment to make an investment in year 2 till the year 3. And this will be 7%, it turns out. There is no magic here, and you will see in your homework, I will give you one exercise where I will ask you to show that if this equation doesn't hold, there is actually a riskless way to make money. You can make some contracts and earn riskless money if this equation does not hold. This is what is called no arbitrage. Arbitrage cannot exist. And I will show you that in the exercises, in the homework. You will have one exercise where you will be asked to show this, and it's very simple. But the idea is, conceptually, this is simple. You have 2 ways to invest money for 3 years. And you know, you are investing your money for 3 years today in both cases. If you invest your money today with 1 contract or with 2 contracts, it doesn't matter. After 3 years, you must end up with the same amount of money. It wouldn't make sense otherwise. You would prefer one or another. You know, if you would get more by 1 contract compared to the 2 contracts, you would always take 1 contract, and then bank would never be able to sell the 2 contract story. Any questions regarding this? Okay. Now we are basically done with these forward rates. I hope you have understood what is a forward rate. It's not a complex concept. And they are basically implied by the current. So forward rates are something that you can always calculate from the current spot rates. This is something that is implied by the current spot rates. Now we talk about the inflation. Everybody more or less knows what is the inflation. If I ask you what is the inflation, you will probably come up with some reasonable answer. But before we actually define what is the inflation, let me tell you how the inflation is measured. Well, the inflation is measured in the following way. You take some box of product that average person is using. Like I'm paying for the house, for the fuel, for the services, for food, for shampoos, for I don't know what. And I observe price of these things. And this thing is called Consumer Price Index, CPI. I observe how much is this worth today, how much average person, what is the average price of the things that you buy today. And then I observe the average price of that in a year from now. How much is that in dollars in a year from now? Same thing. And let's say it's $102 I have to pay. That means that we have the inflation of 2% per year. Now, the problem is that this is so much more complex that it's difficult even to describe. Just imagine TV set or a computer. Here, you know, everybody has a TV set, so it has to somehow enter into this bunch of products. And now, 1 year later, this TV set is not produced anymore. What is the price of the TV set that you use? Which TV set? Which computer? In year T, you have simple Nokia phone. In year T plus 1, everybody now has smartphones. Which smartphone? I mean, this is very, very, very complex things. And actually, these CPI indexes are calculated by the governmental institutions. So some government institution usually calculates this stuff. Now, this is one example, and you will see Consumer Price Index for all urban consumers. You know, prices of goods differ in New York and in Austria, or in Alabama, or wherever. So when you say, what's the inflation in Germany? Where in Germany? In Hamburg, Munich, or in Darmstadt? I don't know. It's different. Price of tomato is different in Darmstadt than in Hamburg. To make things even more complicated, if you observe this thing, you will see August, September, June, July, January, whatever. And in this table, you will see unadjusted index, seasonally adjusted index. You know, I heat my house during the winter, but during the summer, I don't heat my house. In Miami, they don't heat their house in winter at all. So this is a very, very complex measure if you want to calculate it correctly. Nobody knows. If you ask somebody what is exactly this 2% inflation, I mean, they have no idea. And actually, I mean, the problem is that governments have incentive to cheat when they are making these calculations, because they want to feel you that there is no inflation or the inflation is low, that your money, that your salary that you receive is not worth less and less each year. You know, I came to Germany 2.5 years ago. And if you check the average inflation rate over the last 2.5 years, I mean, it was negligible. It was less than 1% per year or something like that. It was really, really small. These were years of a really small inflation, at least officially. But you know, when I go to a gas station 2 years ago and now, I pay 50% more per liter of fuel. It was €1, now it's 1.5 euros. And now somebody tells me that inflation is 1%. I somehow don't believe you. I mean, I'm paying 50% more for fuel, and fuel is used to produce everything. So I don't believe you that the inflation is 1%. How do you calculate it? Show me the methodology. And you know, they will change this complex and complicated methodology from year to year. You will never know what the actual inflation is. And how do you deal with inflation when you calculate how much stuff you are actually able to buy? The simplified way to do it would say that imagine that you invest $100 for 1 year. You end up with $110 after 1 year. That means that you have 10% dollars more. But now the question is, how much more stuff you are able to buy after this 1 year? If the inflation was 3%, then somebody would say you are able to buy 7% more stuff. This is this formula, that the nominal 10% is equal to the real, this is the 7% more stuff, plus the inflation rate of 3%. But this is only approximate way how to do things. The real way how to do things is given by this formula. And to give you an example, this is the best understood by the example. Imagine that you have $100 today. And this $100 can buy you 100 apples. That means price of an apple is $1 per apple. Okay? Now, 1 year passes and you have $110. You have invested this money into something and you have $110. That means that nominal interest rate in this case is 10%. You have 10% more money. But how much more stuff are you able to buy? How many more apples are you able to buy? Are you able to buy 10% more apples? Well, this depends on the price of the apples. Imagine that the price of apples went up to $1.03. If the price of apples is now not $1 per apple, but $1.03, you would be able actually to buy 106.8 apples. And this is the inflation of 3%. Price of apple went from $1 to $1.03. And you are now able to buy 106.8 apples. This is 110 divided by 1.03. Now, if you use the formula from above, nominal is 10%, inflation is 3%. That would mean that you need to buy, that you can buy 7% more stuff. Well, you cannot. You can buy 6.8% more stuff. 106.8 apples is 6.8% more than 100 apples. So you have to take into account with this 1 plus R, actually. You know, I mean, this example, I think, is a good explanation how inflation works. The real interest rate is how much more stuff you can buy. Nominal interest rate is how much more dollars you get. And the inflation rate is how many percent the stuff is more expensive. So how did the inflation look over the last more than 100 years in the US? It changed. It oscillated up and down. There were times with high inflation, times with low inflation. It changed a lot. And how does this compare to other countries? Well, you will see that at least historically, countries that were kind of neutral and didn't fight wars were basically low inflation countries over last more than 100 years. So Switzerland, Holland, USA, Canada, Sweden, Norway, I mean, these are basically all the countries that never fought wars. And Germany is quite on the rise because of this war and the post-war period when the inflation was super high. But on the other hand, if you observe things after 60s until now, Germany will move much to the left, while some countries will move to the right, like Spain will stay on the right, Italy as well, etc. Now what I want to say is that if you observe some financial products like bonds, if you observe UK government bonds, you can observe one regularity. And this regularity is, I noticed that at some point during the class, people just start sleeping, falling down, talking, and stuff like this. And usually, in every class when I notice this, I try to throw some joke, to do something to make you, laugh, relax, whatever, and then continue. But currently I'm totally out of jokes. So let me try to do it like this, like a rational thing. Please concentrate a little bit more. We don't have that much left. Okay, so if you observe this chart, these are nominal interest rates from bonds, and these are historical real interest rates from bonds. So what does it mean? The pink line on this chart tells you how much more money these bonds were earning if you own them. So these are kind of yields, but in terms of money. And you see they change a lot. They go from, almost 15% to 3%. But if you observe how much more stuff you could have bought, it's pretty stable. It's around 3%. So adjusted to inflation, actually, this thing is pretty stable. And this is because if you observe what's the relationship between bond returns and inflation, they are quite correlated. If you observe these two charts, they are pretty correlated. Inflation has something to do with return on bonds, at least in the US. In Japan, the situation is quite different. In Germany, it's more like in the US. It's more similar to the US. Okay, now we move to something quite different, which is actually quite similar to what we have done. We will talk about stocks. In our previous classes, we have talked about bonds. Now we talk about stocks. And the idea is, in this chapter of the book, to see how common stocks are traded, how do you value stocks, how do you value companies, how do you estimate cost of equity capital, some financial ratios like earnings per share, etc. So let's first see how are stocks traded. Everybody knows, when I tell you trading of the stocks, I don't know what do you have in mind, but first that strikes me are these people on the floor of the New York Stock Exchange yelling and doing some stuff. Other thing could be, you see some people doing something on their computer or are on the phone with their broker. And actually, what I have described are two types of stock markets: auction markets and dealer markets. These are both secondary markets, what are called. While over-the-counter trading, these are primary markets. Imagine that you have a company that is not traded at the stock exchange, but you would like to start doing that. So what you do usually is you do the initial public offering, or IPO. You you want to raise capital, but you don't want to go to a stock exchange directly. So you organize a presentation for potential investors. I gather potential investors in this room, and I try to convince you how great my company is, so you would give me some money. And I do that, you give me some money. Now you want to, after 6 months, you think, okay, I want to sell these stocks, I need money. Then you would go to the stock exchange and sell these stocks. And there are two distinct ways how you can do it. So I have sold you these stocks, what is called over the counter. This is kind of the primary market for stocks. When they are issued, they are sold over the counter. I sell them, you know, one-to-one. This is first-hand exchange. I build a company and I give you the stock, you give me the money. Now, the second way how to do it, afterwards, you know, it's like buying a new car. You buy a new car in a primary market for cars. You go to a car dealer. But when you want to sell it, you sell it on a secondary market. You go to Mobile.de or whatever. You put it on some website and sell it. This is like with the stocks. In the secondary markets are auction markets or dealer markets. Auction markets, I mean, I don't want to even waste my time talking about this because when you graduate, these things probably won't even exist. I mean, until 2007, New York Stock Exchange was exclusively auction markets. You had these people on the floor, they had a special sign language. You know, they were able to do some special signs with their hands, and this is how trading was done. I mean, there was basically auctions taking place. Who offers more? Do you offer more? Or you offer more, etc. This is how it worked. I mean, this was the only way how stocks were traded on New York Stock Exchange until 2007. Then in 2007, New York Stock Exchange bought Euronext. Euronext is dealer market. It's Nasdaq's competitor. While the Nasdaq is the first dealer market in the world. It started in 1971. And how Nasdaq worked? There was no floor. There were no live auctions taking place. Nasdaq at the beginning looked like a normal internet forum. You know, everybody knows what are forums on internet. I mean, even they are not so popular anymore. But in that time, forums were quite different than they were now. They were more similar to what was called then bulletin board systems. The problem was there was no internet in 1971. So in order to post a message on a forum, you would have to call and connect directly to Nasdaq server. So Nasdaq server had for example, four telephone lines. And then you call Nasdaq server with your computer, with the modem, it connects, you dial in, it connects. You leave a message and say, okay, I would like to buy this stock for $90. Then you disconnect. Then somebody else is looking at, okay, I have this stock, I would sell it, but your price is too low, I want to sell it for more. He disconnects, etc. This is how it worked before. Now in times of internet, everybody is connected simultaneously, etc. Things work more in a real time than they worked before, but I mean the idea is the same. It's electronic trading. Nasdaq is electronic trading and these are dealer markets. There are some indirect ways that you can buy stocks, and this is by buying investment units of exchange-traded funds. So there is some fund who has like stocks. Its stocks is quoted, it's exchange-traded, it's quoted at the exchange. But in reality, for example, imagine that this exchange-traded fund or ETF owns one IBM stock and one Microsoft stock. And when you own part of this fund, that indirectly means that you own a little bit of Microsoft and a little bit of IBM. So you're not directly buying stocks, but the returns on this exchange-traded fund stocks are directly related to the content of the stocks that of his portfolio, of what this fund has been investing into. So what was the idea of stocks? And what's the idea of assets? As we said in our previous class, I mean, you know, you have some company which has some assets. So what are assets of a company? Assets of a company is basically everything that sometimes in the future can somehow be translated into future profits. So this is cash. Cash can be used to be translated into future profits. These are buildings, these are factories. I mean, everything of some value, everything that can be used to produce some value are assets. Now, you know, but company can also raise debt, as we have seen. It can issue bonds, it can go to a bank and and borrow money. And these are what are called liabilities. And for every company, debt plus equity must be equal to assets, or liabilities plus equity, it must be the same thing as assets. Now I have taken from the website of the Securities and Exchange Commission. This is an annual report of Microsoft Corporation. And this is one table taken from this report. So this is the real data from the annual report of the Microsoft Corporation. And what you can see in this table is that total assets of Microsoft, and this is in millions, is basically $108 billion. But you can also see that Microsoft has around $50 billion of debt. They have borrowed around $50 billion. So, in a sense, value of the company is difference between these two things. Value of the equity is assets minus the debt, assets minus liabilities, which turns out to be $57 billion. And now, I mean, these differences must be satisfied in a dollar. I mean, there should not be a dollar difference in these numbers. Everything should add up. Otherwise, somebody is going to jail. Okay. Now, the question is, how do we value common stocks? Now we know what are common stocks. So common stocks are equity, in a sense. Number of stocks times price of the stock must be equal to the equity. But how do we value these stocks? Well, imagine that today you buy a company for a price P0. And that in a year from now you can sell it for a price P1. And in a year from now you receive dividend 1. Then the expected return for such a company is dividend plus the price that you are able to sell it for minus the price that you paid for it. This is basically profit that you make over 1 year divided by the price that you paid for this stock, and this is the expected return. This is the expected 1 year return. But now let's think about valuing companies. So what are companies? Can we represent a company as a cash flow and use discounted cash flows as a way to value companies? Well, imagine the following. Imagine that you buy a company for a price 0. And then this company pays you dividends over time. And then after some time, you decide to sell this company for the price that you can achieve on the market. Well, this would be the cash flow stream representation of such investment. So you pay P0, this is kind of a present value today, must be equal to the sum of all discounted dividends plus in some last period of time, you sell this company for the price PH. And you know, this reminds you a lot on bonds. Bonds have coupons, and at the end, last coupon plus the face value. Stocks have dividends, and in the last period, you sell it for some price. You can sell this stock for some price, plus you receive the last dividend. And this equation must be satisfied. Now the problem is that unlike with bonds, you know, with bonds, cash flow streams are deterministic. This is something that is written in a contract. Bond will pay you this coupon rates and this face value. With stocks, this is not deterministic. We don't know how much in dividends we will receive tomorrow, in a year from now, in 2 years from now, and even less we know for how much we will be able to sell this stock for. But imagine that you have the following example. Current forecast for some company is to pay dividends of $3, 3.24, and 3.5 over the next 3 years. At the end of 3 years, you are hoping you will be able to sell your stock at the market price of $94.48. What is the price of a stock? Given that you are expecting, by taking this risk, to get 12% expected return. So similarly risky company is offering 12% return. Well, we can calculate the present value of this. We can calculate the present value of this cash flow stream, and it's $75. So if these forecasts were reliable, then you would not be willing to pay more than $75 for this stock. And this is the idea. There is nothing but this. This is the idea. And you know, the point is that actually the only thing in order to be able to value firms well is that you need to be able to estimate dividends well. The sales price, the final price after X years, it doesn't really matter for valuing companies. And why is that? Well, imagine that you have dividends if you have a present value of a 3-year cash flow stream. But imagine now that you have a cash flow stream of 50 years. Then the final payment and the final sales price after 50 years, I mean, it would be negligible compared to all the previous elements in the sum, because it would be heavily discounted. It would be in a distant future. I mean, $94 in 50 years from now is worth almost nothing today. And you can actually see at this chart, so the pink, or I don't know, is this a pink or a fuchsia? I'm not sure. So if in a year from now, if your horizon is 1 year, then present value, total present value, depends a lot on the price of the stock that you are able to sell the company after 1 year. So this is the pink part. And only one part of the total value comes from the dividends. But as you increase your horizon, more and more percents comes from dividends. This is the white part. And just a little tiny part comes from the price of the stock after 100 years. Because this is, you know, you sell the stock in the last period. And more periods of time you have, more heavily you discount things. $100 in 100 years from now is just a little in terms of money today. So when we talk about dividends, we can imagine that actually you never sell the stock. You hold it forever. And imagine the dividends are constant over time. If dividends are constant over time, then owning a company is nothing else but owning a cash flow stream that is called perpetuity. Just your cash flow stream that your C over R is actually dividend over R. Or you can make different assumptions. There are different companies. There are these stable companies and there are growth companies. And growth companies, you expect them to pay larger and larger dividends over time. It could be something like this. Well, this is what is called Gordon growth model, and this is probably the most frequently used model in trials. So you have many of these trials when you have companies which are asking for, I don't know, we were damaged for, I don't know, this amount of money or that amount of money. And these trials are in billions. I mean, finally somebody will have to pay to somebody billions in damages sometimes. And you know, the tricky thing in this case is how do you value how much some company lost because somebody did something. You have to be able to value company. And this is actually the most frequently used model to value companies. It's called Gordon growth model. You assume the dividends will grow over time at the constant rate G. If they grow at the constant rate G, the price of a company today, the value of the company today is dividend over R minus G. Now the problem with this model is that, you know, in reality growth varies significantly year by year. It's not constantly increasing with a rate G. I mean, what do you do if, you know, companies currently not paying dividends and you need your first dividend, you need dividend 1 to divide it by R minus G to be able to calculate the price. What if, I mean, many companies don't pay dividends this year. Or the problem is also when R is very close to G, when these numbers are close to each other. Then this is very, very sensitive to any number. So if you change estimate of R or G for just a little bit, or if you change the estimate of dividend just a little bit, price changes a lot. So here is the one example, and this is our slide. If a stock is selling for $100 in the stock market, what is market assuming about the growth in dividends? So, I mean, 100 is current stock price, so this is the price today, is equal to the, let's say, the dividend next year that is going to be paid is $3. So 3 divided by 0.12 minus G. So market is assuming the growth rate in dividends in 9% if this company is well described by the Gordon growth model. I mean, this is just a small introduction into what we will actually do. We will do much more in the next class, and I would end this class here.